It is Tuesday, December 23rd, 2025, and I need you to fully grasp the situation right now before the next session begins. If you believe what we saw today was the main event, you are mistaken. Today was merely the warning shot across the bow. Tomorrow, Wednesday, is the actual test. Because the silver market you have been monitoring for years, the one that pretends paper contracts are the same as metal, is now being forced to answer the one question it can no longer dodge. Can you actually secure the bars? And listen closely, because in about 3 minutes, I'm going to show you the one specific signal that flashed just before the close today, something almost nobody is talking about, that guarantees tomorrow isn't just another trading day. Here is why this is critical. The only market that consistently tells the truth during a physical shortage is the one closest to the physical flow. That market is Shanghai. So tonight, I'm putting a number on the table that will make mainstream analysts roll their eyes right up until the moment it prints. Silver can hit $73 or higher in Shanghai on Wednesday. Not eventually, not sometime next year, but tomorrow. If that happens, Western banks don't just take a financial loss. They lose control of the narrative. They lose control of the mechanism. And they lose control of the price. Because when Shanghai leads, the West is forced to follow or expose the fraud. In this emergency breakdown, I'm going to show you why $70 in Shanghai tomorrow isn't fantasy. It is mathematics. I'm going to explain why arbitrage is broken and what it means when the bridge between East and West collapses. I am going to detail the 4 specific triggers that can push Shanghai above $73 in the next few hours. And I'm going to give you the 3 scenarios for Wednesday because you need to be prepared not just for the price shock, but for the intervention that comes after. The Asian session opens in hours, the premium is firm, and Western banks are about to discover they can no longer control the price of an asset they don't physically own. This is the story of the moment Shanghai takes control. Let's strip the emotion out and talk like adults. In a functioning market, global prices stay glued together through arbitrage. If Shanghai trades higher, banks buy cheaper metal in the West, ship it east, sell at the higher price, and pocket the difference. That activity closes the spread. So if we are seeing a stubborn Shanghai premium and it is not closing, that tells you something simple. The bridge is broken. Either the metal cannot move, the metal isn't there in the size required, or delivery risk is so high that the arbitrage isn't risk-free anymore. Don't gloss over this next part. Once arbitrage breaks, the spread stops being an opportunity. It becomes a weapon. Here's the key idea. You don't need a $10 move to print $73. You need the premium to widen just a little in a thin market where buyers are urgent. If Shanghai is already printing in the low 70s, then a modest widening of that premium, call it $1 to $2, is enough to show $73 on the table. Why would the premium widen tomorrow? Because panic doesn't take the stairs, it takes the elevator. Wednesday is the kind of day where one big buyer, one rumor about availability, or one call us for pricing email can shove the entire market up a level. I want you to understand the transition happening right now because this is the part that destroys models. In a speculative market, price matters. When the price gets high, buyers step away. In a scarcity market, price becomes secondary because the question is no longer, is it cheap? The question is, can I get it? That is the moment we are entering. You can tell because the market behavior changes. Spreads behave abnormally. Premiums don't collapse. Sellers don't appear when the price rises. And the paper price starts floating like a balloon with a rock tied to it. Shanghai is the rock, because Shanghai is connected to physical demand that doesn't care about your chart patterns. It cares about survival, factories, contracts, production lines. And when a production line depends on silver, the buyer doesn't wait for a dip. The buyer hits the bid until the risk disappears. Now, let me show you the 4 specific triggers that can push Shanghai to $73+ in the next few hours. Pay attention to trigger number 3 specifically, because that is the one the banks are most afraid of. Trigger number 1, the premium doesn't close, it expands. This is the simplest and most brutal indicator. If the West had free metal, the spread would be closed already. If the West had easy delivery, the spread would collapse under arbitrage pressure. So if the spread is still there and widening, it means something is clogged. And when the pipe is clogged, price increases don't bring supply. They bring fear. Fear that transforms into bids. Think about it. Arbitrageurs aren't stupid. They understand basic math. If there's a $4 or $5 premium in Shanghai, and it persists for days, why aren't they closing it? Because they can't get the metal in the West in the size required. The system is stuck. And when a stuck system meets urgent demand, price doesn't rise gradually. It jumps. Trigger number 2. Thin liquidity makes normal buying look like a spike. Wednesday can be violent because liquidity is not uniform. The order book isn't deep everywhere. Shanghai doesn't need 1 million buyers. It needs a handful of serious ones. In thin liquidity, a few orders can print a new level and force everyone else to reprice. That is how you get $72, then $72.70, then $73.15 before the public even understands what happened. This isn't manipulation. This is thin market dynamics. Before we hit the third trigger, I need to tell you something. This intel is moving faster than the mainstream news can print it. By the time this hits the headlines, the move will be over. If you want to be the first to know when that $73 line breaks and what the banks do next, hit that subscribe button right now. We aren't just watching charts here. We are tracking the physical flow that dictates the real price. Join us and don't get left behind. Trigger number 3. The West tries to manage the price and fails. This is where things get ugly. If Western banks try to defend levels by selling paper into rallies, they risk triggering the exact thing they fear, a forced cascade. Because on the other side of those paper sales are buyers who don't care about paper. Once the market senses weakness, once it senses they can't push it down anymore, bids get more aggressive. Shanghai sees that and says, fine, I'll take the lead. This is the bank's nightmare. Selling paper doesn't suppress price anymore. It just exposes the disconnect. Trigger number 4. Physical fear spreads faster than headlines. The physical market doesn't wait for CNBC. It reacts to procurement calls. Imagine you are a procurement manager at a solar company. You need 500,000 ounces. Your supplier says, we can do 200,000 now, but the rest is on hold. You panic. You call another. They say, call back Thursday. You call a third and the price is $74. You don't argue. You buy. Why? Because losing a $50 million contract costs more than paying $2 extra per ounce. That is inelastic demand. And when inelastic demand hits a thin market, price jumps. Now, let's talk about why this is terrifying for Western banks. The banks are short. They bet the price would fall. But if Shanghai leads and the West can't follow, the shorts are trapped. They have 3 options: cover and take the loss, hold and pray, or double down. Option 1 is expensive. Option 2 is risky. Option 3 is suicide. They are paralyzed. In part 3, I'm going to walk through the simplest roadmap for how $73 happens in Shanghai tomorrow, step by step. You need to memorize this sequence because if you see step 2 happen, step 3 is inevitable. We have reached part 3. Let's walk through the exact sequence of how $73 prints. Step 1. The premium opens firm, not even higher, just firm. If the premium opens at $3 to $4 or $5, that confirms the bridge is still broken. Step 2. The West hesitates. Paper can't convincingly pull the price down. The market holds. The banks sell some paper contracts, but buyers absorb it. This sends a message. The shorts don't have control. Step 3. One real buyer hits size. Could be industrial or a wholesaler. In thin liquidity, that is enough to print a new high. Once the market prints $73, psychology changes instantly. Sellers freeze, buyers chase, and the premium becomes self-reinforcing. Step 4. The West reacts too late. Anti-paper selling just widens the disconnect between physical price and paper price. This isn't fiction. We saw it with nickel in 2022. We are seeing it now with silver. And you are thinking, but why tomorrow specifically? Because tomorrow has a special mix. Momentum plus thin liquidity plus unresolved spread plus nervous shorts. That combination creates the perfect environment for a spike. Now, let's be disciplined. Here are 3 scenarios for Wednesday. Scenario A, base case from $72 to $73. It prints intraday, premium stays strong. That is the slow burn breakout. It sets up continuation. Scenario B, bull case from $73.50 to more than $74. And the spread screams. This happens if Shanghai buyers interpret Western hesitation as weakness. That is when Western shorts start sweating in public. It is an availability crisis. Scenario C, cooling case. Shanghai holds from $71 to $72, but doesn't spike. Even this isn't bearish if the premium refuses to close. In part 4, the final chapter, I'm going to give you the warnings. Because when a paper mechanism is at risk of being exposed, the system changes the rules. If Shanghai is printing $73+ while the West is still pretending it is lower, expect volatility. Expect whipsaws. Expect propaganda. The banks will blame speculators. They will raise margins to force liquidation. They may even pause trading. We have seen this before, but here's the difference. This time, the physical market is too strong. If they close the paper market, the real trading will move to the street. Closing the casino won't stop the game. It just proves that the house is broke. Now, let me give you the bottom line for tonight. $73+ in Shanghai tomorrow is not a fantasy. It is a logical consequence of a broken arbitrage bridge. If the premium widens even a little, if the West can't close the gap, if one serious buyer hits the tape, $73 prints. And when it prints, the headline will be, Shanghai is setting the real price, and the West is running out of excuses. That is why Wednesday matters. That is why this isn't just another trading day. So here's what you need to watch tomorrow. First, the Shanghai Open. Does the premium open firm? Second, the Western response. Does the market hold against paper selling? Third, the level printed. Does $73 flash? Fourth, the spread. Does it widen? Those four indicators will tell you everything. The storm is building. The Asian session opens in hours, and when it opens, we will know if the banks can hold the line or if Shanghai takes control. Tuesday was the warning. Wednesday is the test. And if $73 prints, Thursday is when the panic starts. So here's the final word for tonight. $73 in Shanghai. Tomorrow is not a prediction. It is a read of market conditions under stress. The bridge is broken, the premium persists, physical demand is urgent, and the banks are out of tools. Subscribe so you don't miss the breakdown tomorrow. The battle for control of silver reaches its climax, and you need to be on the right side of history. Don't get shaken out, don't sell.